today we'll be talking about the economic outlook for 2019. For all investors out there, they must be wondering, what should we expect out of 2019? And we are very, very privileged to host a very important guest. His name is Jared Osoro, and Jared works for the Kenya Bankers Association. He's a seasoned economist, and he's been practicing for more than 13 years. Jared is the Director of Research and Policy. He's also the Director of KBA Center for Research on Financial Markets and Policy. Please welcome. My name is Pius Mushiri Mugo, the Managing Director of Noble Capital, and you're watching Invest in Africa. Jared, welcome.
Thank you so much for having me.
Yes.
Yeah.
It's fantastic to have you here. We've been saying we'll have this conversation. Today has come.
It has happened.
Fantastic.
Yeah.
So Jared, I just want us to start from the global outlook. And I just want to go through some of the key events that we've experienced over the last 10 years. And it started all in 2008 when the post-financial crisis happened. So when the financial crisis happened. And then we saw some ultra-easy financial conditions, which triggered very phenomenal growth in the emerging markets and frontier markets. And what we've seen in the last 5 years is a normalization of monetary conditions. We've also seen tightening of global liquidity. We've also seen power rivalry between US, China, and Russia. We've also been witnessing, very interestingly, populism in politics. We've also seen rising trade protectionism, especially in America, what they're calling America First. We've also seen growing fragility in the EU region, and that and the much talked about the Brexit. So coming to you, Jared, Brexit or no Brexit, what is good for Africa? What should we be praying for now that we're known to be a praying continent?
I think you set the scene very well,
yes.
In the sense that over the last 1 decade,
yes.
This being, I think, slightly more than 1 decade since
yes.
the global financial crisis.
Yes.
A number of things have happened, many of which negative insofar as the global economic outlook is concerned.
Yes.
As you rightly mentioned, it started as a financial crisis and quickly translated into an economic crisis because it's so different.
Yes.
There are a number of financial crises that can happen
Absolutely.
without necessarily translating into an economic crisis. And that's why it was characterized as the Great Recession, meaning, therefore, that we've never seen anything like that since the Great Depression of 1930s. So it was phenomenal. So subsequent to that, we've seen radical policies, one of which, of course, was the quantitative easing that was pursued in the US. But what was unique in the US that they had quantitative easing at the time when they had what's called a fiscal stimulus, meaning that the two policies, the monetary policy and the fiscal policy, were pulling in the same direction insofar as supporting the recovery of the US economy is concerned.
Yes.
The experience in other markets and other regions was slightly different. When the crisis now translated into the Eurozone, specifically in a number of economies, most notably Greece, we had a combination of quantitative easing as championed by the European Central Bank, but we had prescriptions of austerity measures, which was kind of a contradictory policy environment. And we didn't see the policy of the US being put in places such as the UK, which had more or less what was happening in the Eurozone, where you see the Bank of England being very accommodative from the monetary policy stance, but the government pursuing a tight fiscal program, or what they call austerity.
Yes.
And that's why, the recovery has not been even.
Yes.
But what was happening around that time is that the emerging markets were doing pretty well. At that point in time, China and the other emerging markets, some of which have been characterized as the BRICS, were basically doing fairly okay, and in the process dragging the global economy along. There's one thing that is usually not observed when you look at all that, And it's really what you can call a vicious cycle that began from being a financial crisis to being a sovereign problem that translated into a growth problem, which ended up compounding the financial challenges. So breaking that vicious cycle has been a challenge.
Yes.
And that's why anybody who's talking about the global financial crisis, most notably the IMF, have been very cautious in terms of what outlook they give.
Yes.
They express a sense of optimism,
Yes.
but on the back of that, highlight a number of downside risks.
Yes.
The ones that you've highlighted are some of them.
Yes.
You've talked about the geopolitical developments.
Yes.
You've talked about the Brexit.
Yes.
You've talked about the trade wars.
Yes.
All speaking to the subject of an element of anti-globalization.
Yes.
And of course, that doesn't mean very well for the global recovery. So we had instances where, the IMF is talking about the likelihood of the global economy being on the right trajectory insofar as recovery is concerned. At some point saying that the global recovery is not strong. At some point, interestingly, saying that, the recovery is not either upward or downward, instead it's sideways.
Yes.
You could imagine how fragile that recovery is, especially when we started seeing the normalization of the US economy subject to growth and the normalization of monetary policy. And that started from the important date of Ben Bernanke talking about the tapering.
Yes.
And you saw the tantrum that the markets threw.
Yes.
So if you come back to your question of whether Brexit or not,
yes,
I think Brexit is happening. What is uncertain is how is it happening?
Yes.
Is it going to be a hard one? Is it going to be a soft one?
Yes.
Why it should concern us is because of two things. Depending on whether it's a hard or a negotiated Brexit that is soft, will have an implication on the performance of the UK economy. Yes. And by extension, the economic performance of the European Union. Yes. Remember, it's not just the effect of the Brexit on the UK economy. Yes. Because even the EU economy is in a fix insofar as how this thing is rolling out. Yes. Given that we have linkages with the global economy and most notably the European economy, if you know, East Africa has what's called the Economic Partnership Agreement with the EU. Yes. We have to watch that very, very carefully. Yes. But one aspect that is not talked about especially is what does it mean from a regional integration perspective. Yes. In the East African region, we have a very ambitious integration program. Yes. Moving from preferential trade area in quick succession to a customs union, a common market, and you have an ambition of going into a monetary union if circumstances are right. Yes. Now, when you start seeing events like Brexit happening, yes, they actually have a very strong signaling effect on what our kind of regional integration what shape it will take. So beyond looking at the markets, of course, markets will respond, and markets respond to both fundamentals and to news. Yes. So depending on how markets respond, yes, the underlying message is what does this mean for the integration agenda that we have as a region. Yeah, so that is really the picture can paint insofar as the global scenario is concerned, yes, and insofar as the Brexit aspect is concerned. Yes. So on that backdrop, I think the recovery of the global economy is very, very fragile. Okay. Taking into account the fact that even the emerging markets that have basically been dragging the economy along during the Great Recession are also seeing a sense of softening. Yes. You can see an adjustment that is happening in China, transitioning from an economy that is heavily investment growth led, with that investment being funded by credit, transitioning now into a more consumption oriented economy. Yes. So the softening of China, the challenges that we are seeing in the emerging markets start from Turkey, go to Argentina, go to the challenges that Brazil is having right now. Yes. You could see that the recovery of the global economy is compounded by all those developments. Yes. Yeah. So, okay. And just for the sake of our viewers, maybe just to revisit hard Brexit versus soft Brexit, just to demystify for them. Yeah. Yes. Hard Brexit simply means that the EU simply walks. They don't have a deal, they don't have any arrangement, they just exit. That has its own implications insofar as a number of things are concerned. Remember that the EU is an integration arrangement that is at the level of a monetary union. Yes. Even though the UK is not part of the monetary union, that is the extent to which it's integrated. Yes. So at that level of integration, there is free movement of goods and services and capital and factors of production.
Yes.
So you can imagine how disruptive that will be for people working across EU.
Yes.
You can imagine how that will be disruptive in terms of capital.
Yes.
You've already started seeing signs of institutions that have basically been domiciled in the US. I mean, in the UK, moving into the rest of the mainland Europe.
Yes.
The interesting one is one of the champions of the Brexit, actually moving his global headquarters of a thriving business from the UK to Singapore.
Yes.
So that tells you that it's going to a hard Brexit will basically be very disruptive.
Yes.
The other alternative is basically having some negotiations,
yes,
some accommodations,
yes,
and ensuring that the exit of the UK from the Brexit, I mean from the European Union,
yes,
is not necessarily going to be very, very disruptive.
Okay.
And that will allow for a window for some negotiated arrangements between the UK and the other EU members on a bilateral basis.
Yeah.
Yes.
It's been, this Brexit conversation has been going on for some time.
Mm-hmm.
What's the likelihood of hard or soft Brexit? Which one is which one are you most likely to see?
I think things don't look very well, and this is not an economist being pessimistic. You must have seen the vote that happened in the UK House of Commons when the Prime Minister came up with a deal that was negotiated in Brussels. It was a resound defeat. Meaning, therefore, that the parliamentarians were sending a strong commentary that they are not going to take a deal that looks bad, and that now opens a window for two things: either them going back to Brussels and negotiating, and already the signals are that Brussels says that that's the best deal that they offered, or actually looking at going back to the people. In another referendum. And if either of those options don't fall through, then we are seeing the probability actually tilting towards hard Brexit. And that will not be very good, because when you see the Bank of England actually reviewing down what is growth forecast, it's basically saying that the risks of a hard Brexit are probably looking much more likelier. We hope that it won't happen because it's disruptive. But the reality is that it could end up being the case.
You mentioned that the global recovery looks fragile, and I think for the major part of 2018, the US economy was kind of in a boom, and towards the end we saw quite a bit of sell-off and softening of the US economy, which is a big indicator of the global economy. And taking all these things that are going on, trade wars, Brexit, struggle for power between the three economic power countries. What's your outlook or verdict for the global economy in 2019?
You see, the U.S. economy is still the biggest economy in the world. You may talk about China gaining ground on the U.S. and all that, but the U.S. still remains a dominant economy in the world. So what happens there actually has a great influence in what's happening in the global economy. You might have seen the economy actually digging itself out of a hole through the policy programs. So in the current administration, what happened is that there was what you can call the tax cuts, where there's a big debate as whether it benefited a certain segment of the economy, but that's neither here nor there. The reality is that that was really putting the economy on more sugar. The reality is that now is emerging. If you look at the Congressional Budget Office talking about the likelihood of those tax cuts having an implication on not just the fiscal deficit levels, but on the levels of debt. And you are probably a more market person than I am. When you start seeing the yield curves flattening,
yes,
then that is a signal that perhaps the economy is softening insofar as growth is concerned.
yes,
And a flattening yield curve can actually be a pointer towards a recession. It may not necessarily be very precise on the timing,
yes,
but it may be a pointer towards a recession happening.
okay,
It doesn't help that the U.S. has now tested the longest period of a government shutdown.
okay,
The implication of that is yet to be realized, but I think
yes,
the commentary that I've seen indicate that it will have a huge dent on the growth impetus of the economy.
yeah,
And that may be an indication why all the signals that we are seeing from the Fed is that whereas they are on a normalization of monetary policy,
yes,
they probably will start going slow on that.
slow on that, yes,
And that does not mean the same thing as, starting to reverse,
yes,
but I think they may decide to pause.
yes,
So that change of stance would be a signal that perhaps the market is pointing towards a slowdown.
yes,
And of course, we've not seen what you can call very strong inflationary pressure. The labor markets are very tight. And so that simply means, therefore, that the Fed still could be having room to maneuver by, first of all, going easy on their normalization of monetary policy, which will be of benefit to some of our markets.
yes,
But most importantly, communicate that very, very clearly, because at the level and the depth of the sophistication of such a kind of a market,
yes,
policy clarity,
yes,
and the signal that the market picks from a clear policy is going to help.
yeah,
I mean, you've seen commentary about some communications that needed to be clarified,
yes, yes,
and that simply tells you that there's some level of discomfort in the way the state of the economy is going.
yeah,
And that now you build into the China story.
yes,
You build into the what's happening in Brexit.
yes,
You build in the geopolitical developments. You see what's happening in Venezuela,
yes,
and how it evolves. Venezuela being in cahoots with Russia, and
yes,
depending on which position China takes on
yes,
that whole episode,
yes,
and how that now magnifies the global oil prices.
yes,
That will have an implication on how the growth will be for the globe this coming year.
yeah,
The other thing that we don't talk about is that the IMF usually releases its global economic outlook twice a year. They do it in April, they do it in October. In January, they reviewed the outlook.
yes,
And the review was not in an upward direction, but in a downward direction.
yeah,
That simply tells you, therefore, that the recovery is still not that strong.
yes,
Yes.
okay.
Yeah.
So I think what I hear you saying is that the global economy, if nothing is done, we are pointing towards recession. Most likely the Fed is going to ease off, and therefore we are likely to see a slowdown in growth. And some of the adjustments by the Fed may be of benefit to some of our economies.
Yes, but those are not really what you can call fundamental benefits. Those are temporary benefits, because now what will happen is that if the Fed does not aggressively continue its normalization of monetary policy,
yes,
simply means that the interest rate differential that
yes,
could have seen resource outflow out of the emerging markets and some of the frontier markets will not be as substantial as could have been if normal monetary policy could have continued.
Okay.
But that is basically half the story.
Okay.
The other side of the story is really how the dollar is behaving. The normalization of monetary policy has seen the dollar strengthening.
Yes.
So the only way in which the dollar will stop strengthening vis-a-vis other currencies is if you see another bigger central bank normalizing policy.
Yes.
The likelihood of that happening is also limited because the European Central Bank has not gone the route of normalizing monetary policy.
Yes.
Though they could be positive about many things, but they have not gone into the route of actually starting to tighten. The Bank of England, you've seen what's happening insofar as revising their growth outlook and sending a very strong commentary that they are not going to go aggressive on the tightening of monetary policy. The Bank of Japan has been stuck on quantitative easing for a very long time, so you don't see that happening from that end. If China is lowering I could imagine that there are, among the policy measures will be the People's Bank of China,
yes.
Also not being very aggressive on its monetary policy.
Yeah.
So that way, it will mean that the dollar will remain strong. That has its own implications insofar as what happens in the global economy,
yes.
And the regional economy is concerned.
Yeah.
So I think you have to look at that in totality.
Yeah.
Yeah.
So maybe for investors who are seated somewhere in New York, in London, in other big capital cities, who are looking to invest in Africa, what are one of the 2-3 things that they should watch out for in the global space that could have an impact on investing in Africa?
Yeah, I look at investors in 2 ways.
Yes.
They are what you can call portfolio investors who want to come and take a view of the market, take advantage of whichever market situation exists to make a return, as one set of the investors. The other set of investors are really people who are coming for the long term. Yes. And I think the two investors look at more or less the same information in totality. Yes. But the ones that are coming in for the long term look at slightly much more deeper things in terms of the structure of the economy, the policy predictability, the strength of the institutions that support that policy. And I think we could argue that much as we have challenges as a continent, we are making a lot of strides insofar as strengthening our institutions is concerned, ensuring that we have a predictable policy environment, and ensuring that that policy environment is enforced in a manner that attracts investors. So I think when it's not working elsewhere, we can argue that Africa provides an avenue. But I think that has to be on the back of the economies entrenching themselves in a manner that they attract investments outside of the typical extractive industry, which has been basically the main attraction for foreign direct investment. Regarding the other investors, particularly portfolio investors, obviously when markets move, and they move in a manner that makes them take a view that they will have a reasonable return in this market, they'll always come into these markets because, again, our policy environment has always been one that is characterized by open capital accounts, meaning that you can come and invest in a manner that suits your risk appetite and your return expectations. So I think given that the continent looks promising from a stability standpoint, I think that's an opportunity for investors to come through. But there has to be a qualification, and maybe this is typical of us. We always look at both sides of the coin. We can't discount the downside risks that may exist because we are part of the global economy. If it's not working anywhere, we are not the Robinson Crusoe. We are part of that global network. Absolutely. So the linkages that we have will obviously have implications insofar as how we perform as economies. And I think that is why, for instance, depending on which economy you are in Africa, whether you're an oil exporter or an oil importer, you must be exporting some commodity or another. And what I've seen from the numbers is that the commodity prices have a very, very strong association. There's a very strong correlation between commodity prices. So if the oil prices are coming down, most likely the other commodities that are being exported by Africa are also coming down. So that therefore means that the savings that you could make if you're an oil importer will have to more than compensate for whatever you'll lose in terms of the prices of other commodities coming down. And that will speak broadly to what happens on your external account. Fortunately, we've seen a number of economies see their external account close. That's a good thing from a stability standpoint, but from a resource flow standpoint, probably have to look at the pace of that closing of the current account, because the current account basically is similar to the difference between your domestic investment requirements and your domestic savings. And if that difference reflects a savings gap, it simply means that you have to continue relying on external savings for purposes of supporting your domestic investments. So there's an opportunity, but that has to be considered alongside the downside risks that may emerge as a result of what's happening in the global environment.
Okay. Thank you so much, Jared. I think just to conclude for investors, I think what Jared is saying, the global economic outlook looks a little fragile, and the African opportunity is still promising, but you still need to watch out on the linkages that will come with some inherent risks as far as investing in the continent is concerned. I think for long-term investors, what I hear you saying, there is a case of investing in Africa. Thank you for watching. I hope that conversation with Jared has been informative as far as how the global economic outlook affects investing in Africa. My name is Pius Moshire Mugo, the Managing Director of Nampo Capital, and you're watching Invest in Africa.